So a long time ago, I asked myself a simple question. How would I remove 99.9% of my personal liability like that? The safest form of payment that exists on the face of the earth, and that is a credit card.
You would have received a credit card offer at some point in your life, or maybe regularly, whether it arrived in your inbox or mailbox. The offers really sound appealing.
Well, sounds appealing.
Well, who doesn't want free money or points to travel around the world? But have you ever wondered what exactly are these credit card rewards and who actually pays for them? Well, the concept is straightforward. Hello everyone. In today's video, we try to look at and give you all a better understanding of credit card rewards and who actually pays those rewards. Make sure to watch the video until the end so that you don't miss out on anything. So without wasting any more time, let's get started. You all use your credit card to pay for items, and the card issuer rewards you with points, miles, or cash back. Credit card rewards have a fixed value that varies depending on the offer and the credit card issuer. But if they're just free money, as advertisements may lead you to believe, why do credit card companies have them at all? Credit card companies, in short, pay for rewards. To understand how this setup is profitable for those companies, you must first understand how credit card companies make money. At some point in your life, have you ever thought that there may be chances that you yourself are paying for the rewards you earn? Well, sometimes you do that indirectly. At a minimum, you pay for some of the rewards you earn through increased prices on the goods and services you buy. Credit card companies charge merchants a fee to accept cards as a payment option, which the merchants pass on to you in the form of higher prices. If you do it right, you can earn a lot of money than you pay for. Merchants charge the same price to everyone, so you'd pay more whether you used a card that offers points or paid cash. According to the findings of a study by some economists, some cardholders themselves bear the costs of the rewards earned by them. Some cardholders benefit from the benefits, while others pay for them. The distinction is determined by how carriers manage their card purchases and balances. According to them, sophisticated consumers benefit, while naive consumers pay. Points systems encourage more spending. Sophisticated consumers pay off their credit card balances regularly and reap the benefits at little or no cost. Naive consumers do not pay down their balances as frequently. The interest and fees they pay for carrying balances outweigh the benefits of the rewards. Card companies also remain in benefit in a variety of ways as well. Cards that offer rewards typically have lower interest rates than cards that do not. However, because the rewards encourage more spending, the gullible consumers pay more total interest because their balances are higher than they would be without the rewards. Card issuers profit from the fees charged to merchants. Interchange fees may be the least familiar on the list to an average credit card user. On the other hand, it will be all too familiar if you're a business owner or a merchant of any kind. When a credit card is used to pay for a product or service, the merchant is charged an interchange fee ranging from 1 to 3% of the total charge. The term interchange refers to the complex payment network that makes these charges possible, and the fees vary depending on the number of transactions processed by the merchant. According to Brian Riley, who is the director of the credit research group at Mercator Advisory Group, while interchange fees appear to be high, lowering them may do more harm than good. In many studies on the Australian market, where the Reserve Bank imposed few interchange price controls, consumers benefited from the mandated reductions. It won't be a surprise if we say that Riley is not alone in his viewpoint. The biggest threat to credit card rewards would be capped interchange fees, which has happened in Europe on both credit and debit cards, but only on debit cards in the US. To understand why capping interchange fees may harm consumers, it is necessary to first understand some of the legislative forces that influence the credit card market. Consider the Durbin Amendment, which was included in the Dodd-Frank Act in 2010. The Durbin Amendment had a limited and unequal impact on merchant costs of accepting debit cards, and for some merchants, it raised the costs. According to an economic brief issued by the Federal Reserve Bank of Richmond shortly after its passage, If you live in the United States, you almost certainly use a reward credit card when you eat out, buy groceries, or travel. Well, the reason behind that is very simple. When you use a reward card, you get the money back, either directly or, as in the case of cashback, or indirectly, via miles and points that can be redeemed at airlines, hotels, or certain retailers. The reward card market is booming in the US, where banks paid out $35 billion in rewards in 2019. And it is expanding elsewhere, including in Europe. Since banks generally charge lower interest rates on reward cards than on traditional cards, switching from a traditional card to a rewards card should result in a net gain for consumers. But is that the case? Frequently, the answer is no. The main reason is that people tend to focus on the immediate benefits while ignoring the costs, which appear later and are difficult to quantify. Banks design and advertise reward cards with promotional low or even zero APRs and a large sign-up bonus, knowing that people have behavioral biases and limited self-control. This provides consumers with a strong incentive to spend to earn cashback and points. Some people can make the most of their credit cards by selecting the best one for each type of purchase to maximize points, miles, and cashback. These types of people also make sure that their balances are always repaid at the end of the month. However, not everyone is successful. For many, being able to obtain cheap credit puts them at the risk of excessive borrowing and debt distress. This is indeed the case in a recent analysis of supervisory data on the quasi-universe of US credit cards. When you take into account the fees and interest charges people incur whenever they do not pay off their balance in full at the end of the month, only a small percentage of credit cards result in positive rewards. People are strongly encouraged to spend money even beyond their means due to promotional zero interest rates on balances and higher reward rates. Since borrowing appears to be so inexpensive, this happens more often than you might imagine. However, once the promotional period expires and the real APR takes effect, using a credit card to borrow money becomes extremely expensive and can cancel out the benefits, resulting in net losses. As a result, while some people benefit from reward cards, others lose money, and not just a little bit. Reward programs are frequently portrayed as a form of reverse Robin Hood, in which the poor pay for the credit card miles, points, and cash back that the wealthy can use. But at best, this explanation is lacking. Instead, reward cards mostly redistribute advantages from unsophisticated consumers to those who are. This is clear from the graph shown right now, which compares the net rewards on each card, that is, the sum of the rewards less any fees or interest, to the cardholder's credit score, which is regarded as a gauge of financial sophistication. People can make better financial decisions by taking steps to increase their financial literacy and awareness of the costs of taking on credit card debt. Thanks for watching the video until the end. We hope you liked it. Do let us know your thoughts in the comment section down below. Until next time.